The Federal Reserve has decided to keep interest rates unchanged. This decision comes as inflation remains a concern. The Fed aims for a 2% inflation rate. However, current inflation is higher than this target. The decision to hold rates steady is a cautious one. The Fed is trying to balance the risks of inflation with the need for economic growth. Higher interest rates can slow down inflation, but they can also make it more expensive for businesses to borrow money and invest. This is the first interest rate decision since President Trump began his second term. His policies, including trade tensions and tax cuts, could impact inflation. The Fed will closely monitor these policies in the coming months. President Trump's policies are a key factor in the Fed's decision-making. His trade wars and tariffs have created uncertainty in the global economy. These policies have the potential to push prices higher, further fueling inflation. Trump has also called for massive infrastructure spending. While this could boost the economy, it could also lead to higher inflation if not managed carefully. The Fed must weigh these factors as it sets interest rate policy. The president has been critical of the Fed in the past. He has accused the central bank of holding back economic growth by raising interest rates. This tension between the White House and the Fed adds another layer of complexity to the economic outlook. The stock market reacted negatively to the Fed's announcement. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all fell. Investors are concerned that the Fed is not doing enough to combat inflation. The VIX Volatility Index, also known as the fear gauge, spiked higher. This suggests that investors are becoming more uncertain about the future direction of the economy. Globally, other central banks are also grappling with similar challenges. The Bank of England has kept interest rates unchanged. The European Central Bank is expected to announce its decision next month. The interconnected nature of the global economy means that these decisions will have ripple effects around the world. The US labor market remains strong. The unemployment rate is at a historic low, and wages are growing. However, there are some signs of weakness. Job growth has slowed in recent months. The Fed will be closely watching the labor market for signs of inflation. If the unemployment rate falls too low, wages could start to rise rapidly. This could lead to a wage price spiral, where businesses raise prices to cover higher labor costs. The Fed's decision to hold rates steady suggests that it is taking a wait-and-see approach. The central bank wants to see more data on inflation and the labor market before making any further moves. The next few months will be crucial in determining the future direction of the economy. Thank you for watching. Don't forget to like, share, and subscribe to our channel.